Navitas Semiconductor is trading live at $29.82, marking a massive surge of 15.31% during the intraday trading session today, June 4, 2026. This aggressive movement follows an explosive multi-day rally that saw the stock skyrocket to an all-time high of $34.17 just yesterday before settling into its current position. While the wider financial markets are wrestling with sticky macroeconomic pressures, shifting bond yields, and anxieties over capital expenditure, this small-cap semiconductor asset is completely decoupling from the broader index. The immense trading volume flooding into Navitas shows a sudden, intense concentration of liquidity that is shifting the risk profile of the entire company. When you see a stock experience a 346% surge year-to-date, the immediate assumption is that the company has finally unlocked massive, predictable profitability. However, the reality underlying this price action is far more complicated and volatile than a simple breakout pattern would suggest. Investors looking at the ticker are seeing an immediate connection to the largest semiconductor powerhouse on Earth, yet the internal fundamentals of the company are still fighting an uphill battle against deep operating losses and massive cash burn. This disconnect between market perception and corporate reality is where the true story of Navitas lies right now, presenting a high-stakes scenario for anyone utilizing an online investment platform. The prevailing narrative surrounding Navitas is that it has become an indispensable direct beneficiary of the immense infrastructure spending currently dominating the technology sector. Retail investors utilizing apps like Robinhood or tracking modern trends on modern investing sites see the massive capital flowing into hardware and assume every vendor in the supply chain is guaranteed smooth sailing. This expectation has been supercharged by the recent events at Computex in Taipei, where the company was explicitly featured in high-profile industry showcases alongside major hardware ecosystems. The market is looking at this validation and concluding that the business is transitionally de-risked, treating it almost like a guaranteed winner in the race to build out massive back-end hardware installations. But when you move past the initial enthusiasm and analyze the structural reality, a different picture appears. Navitas is currently behaving less like a stable utility and more like a highly leveraged speculative call option on the power management sector. The company's market capitalization has ballooned to over $7 billion, yet its trailing revenue metrics remain remarkably small, coming in at just $8.6 million for the most recent quarter. This extreme multiple compression means that the slightest hiccup in execution or a sudden delay in order pipelines could result in an aggressive downward repricing. If you are managing your own capital through an individual brokerage account or self-investing via comprehensive platforms like Fidelity Investments, the day-to-day volatility of Navitas requires an analytical approach rather than emotional trading. The daily swings are being driven by a profound structural shift in how large-scale data facilities handle power distribution. As hardware processors become more dense, the electricity requirements are scaling exponentially, transforming power management from a boring engineering afterthought into the single most critical bottleneck for the next generation of data facilities. Navitas has positioned itself directly in front of this problem by offering specialized components designed to replace traditional silicon chips. The market's current expectation is that these specialized parts will completely dominate the high-power computing market over the next 24 months. The reality, however, is that large institutional buyers are notoriously slow to completely overhaul their supply chains, and the company is still exposed to intense competition from entrenched multi-billion-dollar legacy chipmakers who are rapidly developing their own competing material technologies. This creates an intense tension between the rapid stock price appreciation and the actual slow-moving commercial implementation on the ground. Looking closely at the recent trading activity, institutional interest has picked up dramatically, with major asset managers like BlackRock and Vanguard adjusting their positions in the stock. This institutional accumulation has provided a strong floor for the price action, preventing the sudden sharp collapses that typically plague small-cap technology stocks after a multi-100% run. The volume profile over the last 48 hours reveals that massive blocks of shares are changing hands, indicating that large portfolios are actively rebalancing to gain exposure to this niche within the hardware landscape. Comment below how many shares of Navitas Semiconductor you currently hold in your portfolio, or if you prefer sticking to larger, more established chip companies. This massive influx of liquidity is happening at a time when the broader indexers are experiencing choppy, defensive trading, making Navitas a magnet for speculative capital looking for high-growth alpha. Investors utilizing sophisticated platforms like Interactive Brokers are capitalizing on these short-term momentum waves, using advanced charting and order routing to trade the massive daily ranges. The high implied volatility means options premiums are exceptionally expensive, reflecting a market that is preparing for wide, unpredictable price swings in either direction over the coming weeks. To fully understand why the stock is experiencing this level of intensity, we have to look at the underlying technology that forms the core of its business model. Founded in 2014 and headquartered in Torrance, California, Navitas specializes in designing next-generation power semiconductors using gallium nitride and silicon carbide instead of traditional silicon. These materials allow electrical systems to operate at much higher frequencies, voltages, and temperatures, while drastically reducing power loss and physical footprint. The core business model relies on selling these specialized components into high-growth markets, including electric vehicles, renewable energy systems, industrial equipment, and most importantly, high-density data servers. In the past, the company focused heavily on consumer electronics, providing chips for fast chargers used in mobile phones and laptops. However, management recently executed a massive strategic pivot away from these lower-margin, highly cyclical consumer markets to focus almost entirely on high-power enterprise infrastructure. This pivot is the primary reason why the stock has caught fire this year, as Wall Street is rewarding the company for aligning itself with the capital expenditure boom in the data center space, even though the financial transition is still in its early unprofitable stages. When you analyze the older financial reports and historical performance, the structural risks become even more apparent. In the first quarter of this year, Navitas reported a net loss per share of 15 cents, which missed consensus Wall Street expectations by a significant margin, even as its revenue managed a slight sequential beat to land at $8.59 million for the most recent quarter. The company's gross margins have been severely pressured by the massive research and development costs required to bring these advanced material platforms to market, alongside the heavy capital investments needed to secure manufacturing capacity. Historically, Navitas has operated deeply in the red, relying on capital raises and equity emissions to fund its operations while it attempts to scale its production volumes. For self-directed investors browsing through investing sites or checking stock screeners on SoFi Invest, these historical metrics can look alarming. A traditional value investor would look at a company trading at an astronomical price-to-sales multiple with deeply negative earnings and immediately walk away. Yet the forward-moving momentum has completely overridden these backward-looking metrics because the market is pricing in a massive exponential inflection point in order volumes that hasn't fully shown up on the balance sheet yet. This brings us back to the crucial balance between expectation and reality as we look toward the future outlook for Navitas. The optimistic scenario that the market is currently pricing in assumes that the company's recent high-profile ecosystem collaborations will seamlessly translate into massive multi-year supply contracts. If these specialized power delivery boards become the standard architecture for all upcoming high-density server installations, the company's revenue could easily scale from under $10 million a quarter to hundreds of millions of dollars over the next few years. This would rapidly compress the valuation multiples, validate the strategic pivot to high-power markets, and push the company into sustained profitability. Shareholders utilizing automated systems like Schwab Intelligent Portfolios or trading actively through online investing accounts are betting that this operational inflection is an absolute certainty. Furthermore, the rising demand for energy efficiency in industrial grid infrastructure and electric vehicle powertrains provides secondary growth avenues that could sustain the business if data center spending experiences a temporary cyclical download. Conversely, the risk-heavy reality presents several major catalysts that could easily disrupt this bullish thesis. The biggest threat to Navitas is execution risk and the intense competition from much larger, well-capitalized semiconductor giants. Companies with massive balance sheets and deeply established relationships with global enterprise buyers are investing heavily in their own gallium nitride and silicon carbide programs. Navitas has a first-mover advantage in certain high-frequency designs, but it lacks the sheer financial muscle and manufacturing scale of its larger peers. If a larger competitor introduces a comparable power management solution at a lower price point, or if major platform developers decide to diversify their component supply chain to mitigate single-source risks, Navitas could see its projected market share evaporate. Additionally, because the company is not yet profitable, it remains highly sensitive to macroeconomic conditions and tightening credit markets. If inflation remains sticky and interest rates stay elevated, the cost of capital will rise, making it significantly more difficult for Navitas to fund its ongoing operating losses without diluting existing shareholders through further equity sales. Ultimately, Navitas Semiconductor finds itself at a fascinating crossroads where market psychology and cutting-edge engineering are colliding to create extreme price action. The expectation is that the company has secured a permanent, highly lucrative position at the vanguard of the infrastructure boom, insulated from traditional market forces by the sheer necessity of its energy-efficient technology. The reality is that Navitas is a small, unprofitable business executing a difficult corporate transformation in a highly competitive, capital-intensive industry, where its current multi-billion-dollar valuation leaves absolutely no room for error. For investors managing their portfolios across different platforms, whether keeping an eye on core positions through Schwab Intelligent Portfolios, tracking broader technology trends via modern investing sites, or executing quick tactical adjustments on a mobile app, this asset demands continuous, unemotional monitoring. The massive year-to-date gains have rewarded early believers handsomely, but sustaining these levels will require the company to rapidly transform its undeniable technical achievements into concrete, predictable, and highly profitable revenue streams. As the initial excitement from recent global technology showcases begins to settle, the focus will inevitably shift back to quarterly execution, margin expansion, and concrete order backlogs, separating the long-term structural winners from the short-term momentum plays. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell subscribe for more updates.